Hello and welcome to this seventh episode of Investing Not Rocket Science. In the first episode, I defined a basic framework for this investment portfolio. The investment is 1 million US dollars. I'm looking to invest into equities and bonds, and I plan to actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the investment horizon that I'm looking at, the investment universe I'm looking at are the developed and emerging markets. From episodes 2 to 5, I added Google, Emerson, and Infineon to the portfolio. And in episode 6, I looked at government issued bonds and shortlisted the UK gilts. In the last episode, I provided a first portfolio update and looked at the portfolio performance vis-a-vis the benchmark. In this episode, I'm looking at automotive stocks. I would like to add one or two of these stocks into the portfolio. The stocks that I'm looking at today are Tesla, BMW, Mercedes-Benz, Volkswagen, and Toyota. All right, let's dive in. Company financials, and straight away, I can see that Tesla is trading at about 8 times its annual revenues, while BMW, Volkswagen, Toyota, and Mercedes are all trading below their annual revenues in terms of the market cap. Okay, so that makes these stocks more interesting at this point in time. In terms of unlevered free cash flow, Tesla, BMW, and Mercedes are the three that have positive unlevered free cash flow. In terms of net income to shareholders, Tesla has 15.4% returns. Toyota has 6.8 plus about 2.9 in dividends. BMW has about 13.7 and 5.9 in dividends. And Mercedes has about 8.9% returns and about 7.2% in dividends. Okay. From this perspective, it looks like BMW and Mercedes are the ones that are most attractive from the perspective of company financials. Okay, efficiency, valuation, and volatility. Tesla has a 68% volatility, while Toyota, BMW have their volatilities in under 30%. Mercedes and Volkswagen are about 33 and 42% volatility, respectively. In terms of operating income, Tesla has a 16.8% operating income margin, which is very impressive. It's in fact the highest. Uh, Toyota has a 7.2% operating income margin, BMW 10.6, Volkswagen 8.8, and Mercedes 12.2% operating income margin. In terms of price earning ratio and PEG ratio, Tesla is at 52.2 price earning ratio. That makes the stock very expensive. Toyota is at about 10.4, BMW is at about 3.5, Volkswagen is at about 4.5, and Mercedes is at about 6. In terms of PEG ratio, Tesla has positive PEG ratio, and so does Mercedes. Don't have the information for BMW, but from this analysis, again, it would be BMW and Mercedes that are more interesting to look at from the portfolio perspective. While Tesla has excellent PEG ratio, it's an expensive stock at this point in time, I think. Okay, in terms of revenue, Tesla is leading the way with about 59% revenue growth, which is incredible. While all of the other four are between 10 and 17% revenue growth. Now, obviously, a 50% growth is not something which maybe it's sustainable by Tesla, so we can see that that's dipping, or for any car manufacturer for that matter. But it is impressive nevertheless. It's a growth stock compared to the other four. I would look at Tesla as a growth stock primarily also because Tesla is just is generating all these revenues from two models, basically, while most of the other car manufacturers have at least 10 to 15 models out there. Okay, in terms of consistency, I think BMW is most consistent. It in terms including the time when we had the COVID lockdowns. Okay, in terms of operating income margin, again, BMW is impressive and consistent, between 9% to 10% of operating income margin, while Tesla is also quite impressive. It is showing steady growth in operating income margin. It's at about 16%. That's really leading the way here. Um, in terms of inventory, they're all largely flat. Tesla's inventory is rising. This probably is also one of the reasons why they've offered discounts on their cars recently, to most likely to bring down their inventories. Okay, nothing much to look at here. Part of the business cycle, it's all pretty flat. Capital expenditure, there's some variations here for Tesla, and Toyota was leading the way, but it's kind of dipping at the moment. Pretty flat for Volkswagen, BMW, and Mercedes. All right. Interest expense again, largely dependent on the debt on the books. And currently, Volkswagen's paying 2.1 billion of interest every year. And this is only going to rise with the rising interest rate scenario. Okay, unlevered free cash flow. Right, I'm looking for some consistency in generating unlevered free cash flow, and from that perspective, I think Tesla and BMW are the most consistent. And while the others have seen some volatility in the unlevered free cash flow, uh, in the last 5 years, these two have been most consistent. Okay, let's look at valuations. I've looked at two methods for valuations: the discounted cash flow analysis and the analyst target. And from both perspectives, I see that the most attractive stocks are likely to be BMW, Mercedes, and Toyota. From the discounted cash flow analysis, Toyota has a 67% potential upside. Okay, in terms of the charts, I've looked at BMW and Toyota. Toyota because of the potential upside that I saw in the discounted cash flow analysis. They're both in an uptrend. Of course, in case of a recession or a recessionary scenario or an economic slowdown, these stocks are likely to get pounded because they fall into the consumer discretionary sector. However, from a valuation perspective, BMW is very attractive, and through economic downturns, I have seen some consistency in their operating margins as well, and their free cash flow. So that makes this stock a certain buy in my investment portfolio. With regards to the others, Toyota, Tesla, Mercedes, and Volkswagen, I'm going to put them on the watch list and come back to them at a later point in time, particularly Tesla, who's also got rising trends in their operating income margin and free cash flow. However, the stock is slightly expensive for my liking today. But if there's some sort of a pullback or a correction, I would look at adding Tesla to my portfolio as well. All right. In the next video, I evaluate financial stocks. All right, this is Investing, Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Please visit our website for the full disclaimers and terms. We can connect on LinkedIn. Thank you for watching, and I look forward to seeing you in the next video. Bye-bye.